games, and collectibles. The initiation report is available to you on channelcheck.com. Alliance was initiated with an outperform rating and an $11 price target. And I think you'll hear today a compelling story. With us is Bruce Ogilvie. He's the executive chairman. And with that, Bruce, I'm going to turn it over to you.
Michael, thank you very much. Good morning, everybody. Yes, I'm Bruce Ogilvie. I'm the executive chairman of Alliance Entertainment. And what you're seeing on our screen here is a sample of all the many different products that we distribute. These are entertainment products, collectible products consisting of movies, music, video games, toys, and collectibles. We buy from all these tentpole suppliers. I would call this the top shelf gold standard of suppliers of entertainment products. It's not easy to get open with these suppliers. You have to have a strong balance sheet, be fiscally responsible, pay your bills on time, add value to the marketplace, and we check off all those boxes. And of course, you have to have a strong retail customer base that you sell to where you add some value. And here's a listing of all of our top customers. Kind of follow the, 80% of your business done with your 20% of your customers, and these would fit that category there. These are all omni retailers, brick and mortar retailers, independent retailers, or just pure online retailers. We offer them every product that we carry in our facility in Shepherdsville, Kentucky, with over 340,000 SKUs in stock as a stocking distributor. We are electronically, or we're tethered to these retailers where they rely on us with our EDI feeds, our ASN feeds, of sharing with them what quantity we have on hand, what location that we ship from with the zip code, as well as all the metadata and the artwork that's needed to populate their websites and what price they'll pay from us to do that. With these retailers, 60% of it is shipping to traditional wholesale, where we're shipping directly to the physical locations, and the other 40% of our business is where we're shipping. We're doing drop shipping on their behalf, where we're making it look like it came from that retailer, but it was really shipped and picked, packed, and shipped by Alliance Entertainment out of our facility. Just to show you, we're not a one-trick pony. We're very diversified in all these different categories. Music, video, toys, collectibles. You can see here vinyl is our top category here, there with $337 million, 32% of our revenue. If you add in CDs, that's another 12% there. So that puts us close to 45% of our revenue is the music category.
Hey, Bruce, can I hop in on this slide real quick?
Yes.
Hi, this is Jeff Walker. I think also one of the things to really look at is Alliance is really selling collectibles. We're in the collectible business, and I'm sure all of you on this call have something that you collect, and it's a really big aspect in the collectible business in music, video, gaming, as well as what we call collectible figurines and so forth. I'll give an example. There was a press release today on Taylor Swift, and we were very instrumental in the distribution of the Taylor Swift album. And when you think about her album on CD and vinyl and all the other aspects of different things that she makes, all that is collectible items. People are listening to her music. They're getting her music digitally and so forth. But why do they buy all that stuff? Is because they want to collect something of hers, and they're building a collection, and they're fans. And so that's right where we fit into this. It's music and video and gaming has all been collectibles in the past. We all used to have big collections of different things, and fans still collect their favorite things. So that's why this is important here in this category. And you look at that Taylor Swift stuff, she's not giving up on giving her fans something to collect with all the different versions and all that. That goes right into exactly what we're working on here at Alliance.
Yeah. In addition to Taylor Swift, K-pop, any K-pop artist, we're a distributor of that. That's another growth carrier, and that creates a lot of collectible opportunities for the Uber fans. You'll also see our video went from 205 million to 276 million, and I'll explain more about that later and why. But it has a lot to do with our exclusive licensing opportunities that we have now that just started this year with Paramount there. Quickly here on this slide here, you can see our revenue year over year is pretty constant, 1.1 billion versus a little below 1.1 billion. But the big number here is our earnings went from 9 cents a share to 30 cents a share. And I'll talk more about why that's happening, why it's going to continue to happen there. EBITDA, 24.3 million went up to 36.5 million. You can see the percentage 2.2 to 3.4. We're very fiscally responsible here. You can look at our balance sheet down there. You see that our balance sheet, our debt went down from almost 80 million down to 65 million. That's happening because we're generating free cash flow. And we expect to continue to generate more free cash flow this year we're currently in than last year there. You see our inventory levels are maintaining there. So all good metrics there follow there. The capital structure, Jeff and I own pretty much, there's a total of 51 million shares outstanding. Our intent was to have a more float out in the marketplace there. But because of the D-SPAC and how it all turned out, Jeff and I ended up with about almost 48 million of the 51 million shares that are currently outstanding today. We have of our shareholders, we have 724 employee owners that are also in the stock. So we think we're in a real good spot here with our employee ownership and everybody being involved. And there's definitely more opportunities for our stock to increase.
Yeah, and one last thing to add here is our debt is based on our asset-based line of credit. We just switched over to Bank of America at the beginning of October, $120 million line of credit, a 5-year term, SOFR plus 1.62, and we use our inventory and receivables as collateral for that. So that's how we help finance it.
Yep. So here's the quarter that just ended. The highlight here that I want to point out to you here is we went from 11.4% for the quarter up to 15.8%. And that's, once again, that's the Handmade by Robots that I'm going to talk about more, and Paramount licensing opportunity. Earnings per share, 5 cents to 11 cents. And of course, you can see the EBITDA there, 2.1 to 12.2 million EBITDA. All good things going in the right direction. Of course, our net income, went up 2.5 to 5.8 million there. Now you can see here, if you look at the full 12 months, counting the Q4 that just ended here for us, for the whole year, for the 12 months is 11.7, went to 12.5. But that one quarter alone is what is going to be a pattern you're going to see in every quarter with our current fiscal year. So you're right at the ground floor of good things to happen for Alliance Entertainment there. We'd like to talk about technology in our operation. We wouldn't get to where we were at if we didn't have a very efficient distribution operation here. While I'm jibber jabbering here, I'll take us on a little tour of our warehouse virtually here. You take a little ride there. So we have this Shepherdsville facility, 873,000 square feet, counting the mezzanines that we have there. One big investment we have in there is a system called AutoStore. AutoStore is this big red box that you might see in our picture there. And there it's coming in now in the background there. And these are robots that go around the top of all of our LPs that we have stacked up in crates and totes. The big thing with AutoStore is instead of having the picker walk to the shelf and to a location, which is that travel time, there's no travel time. The shelf comes to the processor, the picker. And so we went from 41 processor pickers walking to the shelf down to 7. Big payroll savings. We invested in this, started this project over 4 years ago. We're currently in our 3rd year of using AutoStore. We have 1 more year to go next year. And the beauty of all that is that AutoStore will be fully paid off by next year. And so there will be no more cost associated. It's about $250,000 a month for the lease and operation. At the end of the 4 years, it's a $1 buyout, so we'll own it there.
And that is paid off. Yeah, that's paid off January of 27. So we have just 13, 14 or 14, 15 months left.
Correct. So we talked about all our products that we sell to all these retailers. A very large customer base that we have is all these independent music retailers, over 3,500 independent music retailers. They all sell vinyl and they rely on us to get their vinyl. The independent retailer has really had a resurgence over the last 15 years. Really, they have no competition right now to speak of what they had in the past. But not only that, they have no competition, but the artist in the industry really got behind them over 15 years ago and said, we're going to come out with a very important day. Exclusively, we would come out with new releases of product that's only available in your independent music store. No Alliance, I'm sorry, no Amazon, no Barnes and Noble, no Walmart, only independent music stores. It happens twice a year, April and November. The last April, they just came out. We did a little over 660,000 units we shipped in that. That's why our quarter was so strong. Also in Q4 that ended there also because of that. In November, there'll be another record store day. And the one thing that happens every year with record store day is it just gets bigger and better. And you're talking about these small stores doing a couple $100,000 over the weekend there, which is really impressive for independent music store there. And we're a large part of that, their success there. What kind of empowers these guys is the relationship that we have, our Amped exclusive music distribution division. This is over 110 labels that we are the exclusive distributor of. These labels, some of these labels are, very large in size, and they rely on us to do all their physical distribution. They can't do it themselves. They really need us. They can do their own digital, but they really need us to do the physical distribution to reach all these brick and mortar locations or ship directly to the consumers there. And that's where we come in there. It's about $85 million in revenue in the fiscal year that just ended. We added on another new big label there. It's called Virgin Music Group. They're just getting started here. It should add about another $20 to $25 million to the AMP division there. And this is just something that is homegrown. We started, it's all organic. It's been growing every year and we'll continue down this path. And it just really comes down as labels that want to rely and do it themselves. They need a company like Alliance to do the physical distribution, and they don't have to go with a major record company. They can count on us.
And the last part is when it's exclusive like this, all these labels running through us, the exclusive means we sell it to all the retailers, including Amazon, Walmart, and so forth, all the indie stores. So everybody gets it, directly from us, which is a huge win in any of the divisions with exclusive product.
Yeah. On our theme of exclusive content, we want to talk about Alliance Home Entertainment. This is our same division like AMP, where we have a exclusive content from the studios. We have 48 studios where we're the exclusive distributor. We also have a division that licenses, that's called Mill Creek, where we license content. Just recently, January 1st, we were able to get the exclusive rights for Paramount Pictures. Paramount Pictures decided, like Disney decided earlier, that they wanted to outsource their home entertainment division. So we got that in 2024. There was an RFP. We participated in that. And January 1st, we picked up that division there. It did two things for us. The first thing is that, we were about maybe Paramount's current business, we were about maybe 1/3 of their business. That 1/3 we were making, distribution margins as a distributor of Paramount there. And the other 2/3 Paramount was selling to primarily Walmart and Amazon. Well, with us taking over this licensing now, that really increased our gross profit for our 1/3 of business that we were currently doing with Paramount. And then the other 2/3, which was additional revenue that we didn't have before, that brought us a much higher margin. It's really pretty simple. As a distributor, $30 retail movie would wholesale for about $20. We make somewhere in the neighborhood of $1.50 or $1.75 of gross profit on that individual unit selling as a distributor. Now being the licensor and selling this content to anybody and everybody that Paramount had there, our gross profit greatly improved to the $9 range. So same $20 wholesale price. There's a royalty we have to pay. It's about $8. The manufacturer cost is a little, right around $3. So that's $11 for our new COGS number versus $18.50, what our previous COGS was as just a distributor. And you can see why our gross profit now is growing so much. We're just getting started in this area there. There's other studios that want to outsource their home entertainment department there. Had some really good conversations going with Universal Pictures, Warner Home Video, Lionsgate, Sony Pictures, Amazon Pictures, all these studios are looking to follow what Paramount did there. It's just a way for them to reduce headcount. And as their core competency becomes less in home entertainment, where they have a home entertainment division there, they can pretty much pivot to us as a public company being very strong there. Jeff, did I leave anything out there?
No, right there. I think the other thing to add is this particular division, we brought over some senior leadership in sales and marketing from Paramount to join the Alliance team. And that team is really focused a lot on Walmart and Amazon, which are the two big sellers on the video side at this point. And this summer, we were awarded the category advisor with Walmart for the entire video department. And what that means is it's kind of a separate team that's within Alliance that advises Walmart on behalf of all the studios. And this advisory role was previously with Universal, and that moved over and went live with Alliance on August 11th. And it's a big aspect for us. It really shows the confidence in Walmart with our team and what we can do there. And at this point, Walmart is 40% of the physical DVD market. So we're very well positioned with the leading retailer in the video side. And one last part, part of the reason why Paramount moved it to us, it's not core to their business any longer on the physical side, and they moved it to a licensing model, just like toys, collectibles, T-shirts, everything else that they do under licensing. And from our perspective, we have a company that's focused on physical collectible product, and we see DVD as an example of it, no different than a figurine or a toy or a Taylor Swift album or any other album that people collect. So we're the right guys positioned for ultimately all the studios to move over and consolidate this into one supplier, which we believe is going to be Alliance.
Yeah. Another outlet we have is our retail division, where we are the seller of record to these consumer, and through our different little divisions here. It's about 85 million of our total revenue here. It just gives us a great opportunity to be in touch with what the consumer is doing and what their needs and wants are there, and what they're looking for. At the same time, it's also an opportunity for us, if we have any excess inventory that we can't return, to get full credit for. We can sell it at cost to the consumer, and that helps us just turn our inventory quicker there, and reduces any inventory risk. You can see here we're very diversified, selling at any opportunity, whether it be on TikTok, Shein, Temu. We also sell in every eBay marketplace in the world, as well as any Amazon.com marketplace in the world. And then you can see all these different brands that we sell under, as well as our different websites there. So I talked about Paramount, which is exclusive licensing opportunity here. And the other thing that's driving our gross profit is Handmade by Robots. Handmade by Robots is owned by a company called BDA. The one thing they lacked was the ability to have the great distribution that we have, being so diversified, and all the touches we have with all these large retailers. Jeff found this company here last year. We purchased the IP, and so now Handmade by Robots is ours. It's our form factor, our little knitted figurine that you can see here in the picture here. They're getting a lot of great buzz, in social networking. That's people like what they're seeing there. It's going to be something we're going to treat as a collectible. We're not going to treat it like a toy company. We want to treat it like a collectible, where the right quantity out there in the marketplace there, license the right content and make it available. And we hopefully our plan in the next 3 years that is to grow to be $100 million a year division for us. Through our ecosystem we currently have. And that's another $40 to $47 million worth of gross profit for our operation.
Yeah, and to add to that, we've been adding significant licenses with Disney, Warner, Universal, Sanrio, and so forth. And we can do all different types of characters. It's a great business model because we have a great form factor with the knitted style, and the name Handmade by Robots. I love the name. It's so appropriate right now with all the robot conversation, and this is what a robot would make. And last part on this, we are launching this week. We have a booth at Comic-Con in New York. Starts on Thursday. You guys will see a press release on that Thursday morning. And we've got a lot of our newer titles being exclusively released there at Comic-Con this year. And then we've greatly improved our sales team on our collectible side. So you will see here in fiscal 26 some pretty significant sales increases in collectibles, not only the Handmade by Robots, but we're also picking up a couple other exclusive lines of collectibles, some of them coming out of Japan and China. And they're all licensed collectibles, and we should see a pretty big increase year over year in our collectible business.
On this slide here, our income, I want to just highlight there that our distribution fulfillment expense is coming down as a percentage of sales. That's because of AutoStore. If you look at our interest expense there, that's going to be dropping pretty drastically with the new loan that we have in place that Jeff mentioned about there. And having a lower interest cost is just going to drop to our earnings per share, which is, we expect that to be very good this year, the current year we're in. We talked about our balance sheet there, so you can just see there that, you know, our balance sheet and everything we identified earlier there, there's no changes from what you don't know already there.
I do want to, let me throw one thing on the balance sheet. You know, we mentioned we stock a lot of inventory. We're an inventory stocking warehouse, and because of that, we support a lot of e-commerce business. That's how we get so much of our e-commerce business. Our products available on Target, Walmart, Amazon, and hundreds of other smaller e-commerce platforms. And when you look here on our inventory, we run roughly in the $100 million of inventory range. So we are turning that inventory pretty quickly, 8 to 9 times a year on our inventory turn, which is great for a warehouse that has such a wide selection and so forth there. And that just allows us to have, we may have 2-3 units available, but we can have that, and it's not a high velocity title, but we can have that title represented on all those websites using that same inventory. And all of our retailers love that aspect, that we have this inventory on hand, because they have zero inventory commitment on that. And that's what's driving that CDF business is, you know, it's listed on their site. They take the order, they send the order to us, we fill the order, they collect the money from the customer. There's no inventory risk on all that. And we're not the only supplier of CDF. They do that in a lot of different categories, but we're the driving supplier for all these entertainment products that we stock. And so as we continue to add new products from new vendors and so forth, that those products go through our ecosystem. And that's another way for us to increase sales at Alliance. It's not just to get a new customer, it's also get a new vendor. And I mentioned, you know, we have a new exclusive vendor coming on board on collectible side. And when we sign up that vendor, that's an $8 to $10 million a year vendor. So we look at sales growth from both sides of it. We're looking for new accounts we can sell to and place product in stores and on sites. And we're looking for new vendors that we can represent their product.
Great. So at this point, I'm going to stop here and open it up for questions there. We have a little summary deck here you can see while questions are coming in.
All right. Thanks, Bruce. Thanks, Jeff. Obviously, you're at this inflection point where you're likely to see further expansion of margins and significant increase in cash flow and earnings per share. I just have a couple of quick questions I'm going to squeeze in here. Obviously, you have a very successful agreement with Paramount that has driven some margin improvement this year and looks like into next year as well. I was wondering if you can just kind of give us some ideas of why and contributing factors of what drove Paramount to have this deal with you, and if this could be a framework for other studio deals.
Yeah, I'll hop on that, Mike. the I think I mentioned earlier that it's the actual aspect of manufacturing, distributing, selling physical product like a DVD. It has become a smaller part of the business for a company like Paramount and the other studios at this point. They get large revenue from theatrical, and then currently large revenue uh, from digital, and then they have very large revenue from licensing all sorts of different products. Licensing departments with all these studios and their franchises are huge, and it's a time now when they're identifying that it's time for them to move DVD to the licensing model. They collect royalty on that. So in Paramount's situation, we're the licensee there for DVD. Somebody else, we also license from Paramount for Handmade by Robots. Funko licenses it. They license SpongeBob to put on T-shirts and sneakers and potato chips and whatever those huge licensing departments do. So the studios see that the model is better to go to Alliance. Now, why did they go to Alliance? It's really because of our breadth of customers that we service. They got down to a point where basically they were selling to 40% to Walmart, 30% to Amazon, 20% to Alliance, where we're servicing all the other accounts. And it just got to the point where it made the most sense to go with us. Now, the other part that we're really expanding and was part of our pitch is we're very interested in creating extra collectible product for their movies and their IP. So not only the steel books that are currently made that people collect, but even some other very unique collaborations and products that collectors and fans of those movies will want to have going forward. So we do see we're in active conversations with all the other studios. Each one of them is in different aspects of their life cycle with the physical product, and we do see some big opportunities with that in the future. And ultimately, it would be best if DVD as a format all went through one distributor, one person working on all that manufacturing with the manufacturers and creating the product. We're also uh, building a team, we just launched a team to do the authoring of the DVDs. So we're taking that over as well, and we'll have that capability in-house. So we'll be a full service, complete end to end for all the studios. And it's just, it's a great opportunity for Alliance, and it fits with the longer range strategy of the studios.
And I know that Bruce gave us a little bit of the margin profile for Paramount in the deal. I was just wondering if you can kind of score for us how big of a revenue opportunity that might be. And then also, as you kind of look at other top studios, what type of revenue opportunity might we see for Alliance if you were able to land another studio, for instance?
Yeah. So on the revenue side first, Paramount, I believe, is in the 12 to 15% market share of all DVD. So that's kind of a relation. Um, they all kind of divide it through there. The top being maybe 20%. So it's pretty spread out across all those studios. From the margin perspective, as a distributor on the Alliance side, um, we were buying physical product from Paramount, and our margin would run, I would say, around 12% blended, some a little higher, some a little lower with the business that we were doing with Paramount. As we move to the licensing model, now we're the ones who are having the product manufactured, and so we have a manufacturing cost, and that runs in the low 20% range as a blended overall. And then on the licensing side, the licensing royalty is in the mid 30s as far as the licensing royalties. So when you put that together, you're around a 60% cost of goods on the license side. We add in a little bit on discounting and stuff, and we see ourselves kind of settling in between 30 and 35% on margin when we're on the licensing component. And so our business that we were doing at Alliance went from like 12% to 30, 35. And then we also picked up the Walmart business, which was 40%, and the Amazon business at 30% of the market at the higher margin. So it's really significantly driving margin. We bring on another studio. Each of those studios are really a minimum of 50 million to 150 million in revenue.
Terrific. Well, that's all that we have time for. I can thank you again for listening, and also for us at Noble to be a part of your journey. With that, that's all we have time for. Thank you.
Thank you, guys.